Welcome to Buy, Hold, Sell. I'm Jeremy Hook from TMS Capital. With me on the panel today, Shane Fitzgerald from Monash Investors and Ben Rundle from NAOS Asset Management. Well, it's been a rocky start to February, down about 4.5% the leaders on the market, but the smaller cap stocks doing about 1% worse. So, what have we learnt from this fallout of the market? Shane, firstly with you, What can a small cap investor take from this sort of volatility?
Well, I think the first thing to look at is what's the driver of the pullback. We see this as a pullback, a valuation correction, if you will. Okay. Yeah, the economy's bowling on quite nicely in Australia. US is very strong. There's always concerns over China and Europe, but right at the moment they're pretty narrow.
Okay. Ben, yourself, any big takeaways from this kind of movement?
Look, I think the move was initially started from an inflation picture which looked a lot higher than what people were expecting. Now, if I look to what drives share prices, it's earnings growth. So inflation should drive earnings growth. GDP growth will drive earnings growth. The two of those put together will drive an increase in commodity prices, and Australia's a commodity country. So I agree with Shane. I think it's a short-term pullback. It's hard to see it bouncing back very quickly given the aggression of the move downwards. So I think you probably see this period of volatility sort of hang around for a little while, but I think we'll look back in 6 months' time and see it as a buying opportunity.
Okay, and if we're looking at the market as a whole, some areas more affected than others, which are the more protected areas in the market right now?
The more protected ones are probably companies that have a decent level of free cash flow. So a company we like, for example, is SIQ, Smart Group. It's been an incredible performer. They've got a healthy top line growth rate. At the moment, you can get it on a free cash flow yield of about 7 or 8%. So if you compare that to the risk-free rate, it's actually pretty attractive. And I think it still will get caught up with the rest of the share price moves, but there is a buffer there because of the free cash they're producing. Okay,
Shane, do you think it'll bounce back quickly, or is it something that'll take a bit of time? And if so, where do you go to first?
Well, look, I think it'll take some time to bounce back. We're bullish on the market. We just think the pace that the market rose at last year also has to be put into context as well. We're back to about, I think, where we are back in Christmas sort of thing. So it's not, end of the world type stuff. The other driver going on here at the moment is a view about interest rates going up. Well, we all know that. We also know there's a lot of financial leverage in the system. But this is we all managed, I think, by central bankers, the governments, and the holders of those obligations. So. Yeah, we're not overly concerned by that, but we see the trajectory of the market gains from here being a lot flatter than what they've been in the last, say, 12 months. Okay, and there have got to be some areas you'll be avoiding with these kinds of impacts. Look, I think when you have a pullback like this, the areas of the market that are going to do worse are the ones where there's no valuation anchor that you can hang your hat on. There's companies which don't have any near-term earnings, so the valuation's driven off a DCF or a DDM or whatever. There's a lot of subjectivity about that valuation. And also, the stocks would have poor liquidity. There's a bit of a fright in the market that poor liquidity will hammer them. So the stocks in particular were doing it pretty hard at the moment. Any sort of concept stock. We all love these concept stocks from time to time, but these concept stocks, because there's no valuation anchor to bedrock on, they're the ones that are most likely to be susceptible to a pullback. Great, thanks. Ben, price to sales and things like that started to come out through this little bullish period at the end of last year, valuation being an issue. Is that also where you see it, or is it places like REITs and infrastructure to be careful of? Yeah, I think both actually. I think, REITs, for example, will come back, with the move that we've seen in bond yields. But yeah, Shane makes a great point. The companies that, use a DCF and rely on a terminal growth rate to provide the output of a valuation, that gets adjusted as when rates go higher. So all of a sudden the valuation is lower, analysts pull back their targets and it affects the share price. But, this sort of volatility does create opportunities. A good example of a stock that's reported, M&F Group, they saw an opportunity in their business to spend $3.5 million to get $8 million in pre-tax earnings in 2 years' time. Now, as a fund manager, if we saw that opportunity, we'd jump at it. A listed company that does it gets penalised because they expense those earnings up front, and the near-term outlook looks worse. So that provides an opportunity going forward. Excellent. Shane, the baby often thrown out with the bathwater. Can you give us a stock that you find you're really low and unloved at the moment? Well, the stock we've been chipping away at the moment is Afterpay Touch. Okay. It's had a great run, to be fair, but this business is really firing. We think the product itself is a win-win for both the retailers and the consumer. During this pullback, or just prior to that, they announced they're moving to America. I don't think we have to wait a long time to hear what they're going to do in that marketplace. And if they have even a mockery of success that they've had in the US, what they've had here, there's a lot of upside in that stock. Terrific. Market volatility does provide opportunity. There's some great ideas for you.